Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. So for today's episode, I'm actually going to share with you a question that came into CFO On Demand, and I'm going to answer it for you because I feel so strongly about people understanding the answer to this question that we should all kind of fundamentally understand how tax estimates work and how important it is to understand your obligations as a business owner, but also in a way that's a little bit more practical than what most accountants are explaining. So let me read this question that came in from CFO On Demand, and I'm going to answer it for you today on the show. So here's the question. Hi, I'm curious if as an S Corp, do we have to pay estimated taxes throughout the year? I'm finding they're so inaccurate. Either we kill ourselves trying to pay and we're left with cash flow issues only to be given a refund, or we end up not paying enough and scrambling at tax time. I feel like year to year, so many things change with expenses, write-offs, etc., that it would be easier just to sock away 30% from each check we get. Am I wrong? Thanks, Shannon. So, a la Dear Abby, this is a really good question, and I'm sure that many people struggle with this. So here's my answer to this question, which is basically, how do we handle tax estimates as entrepreneurs, especially when we have fluctuating income and expenses? Let me fundamentally explain the tax estimates thing, and you can decide for yourself how you want to apply this. And this is why it's so hard for most people to explain, because it's so case by case. But here's what you need to think about. You have to look at, how am I earning money from a taxable income standpoint? How am I earning money where I'm not already taxed as I go? Okay. And taxed as you go, I mean like a paycheck, because typically with a paycheck, your taxes are withheld. And what the IRS has done is said, well, we're kind of sick of waiting for all these business owners to wait until the end of the year to pay us. So we're going to give them these 4 installments based on what they paid us last year. We're going to make them pay 4 installments of roughly the same amount next year to make sure that we get our money throughout the year instead of waiting until the end. And that's all this really is. But here's my take on estimates, because a lot of accountants will say, no, you're required to pay your estimates every single quarter and you have to make sure you're paying those vouchers. What this advice fails to take into consideration on, though, is just the nature of entrepreneurship, because those estimates are based on the prior year's information. If you had a gangbuster year last year and this year you've actually downsized a lot, you've let a lot of people go and you're completely pivoting your business, then a lot of the circumstances that applied last year no longer apply to you. And the same goes the other way, vice versa. You may actually have way more going on this year than you did last year. You may be skyrocketing your profits, and those estimates won't even be nearly enough to cover what you're going to owe. So in each situation, here's what you need to consider. Is these are meant to be a guideline to say, at a minimum, if you pay these vouchers, you won't get hit with a penalty. Okay? If you pay these vouchers, you won't get hit with a penalty. However, if you don't even owe this much by the end of the year, like if you pay these vouchers and you overpaid, then you're going to get a refund. And if you pay these vouchers and they're not enough because you outperformed, you're going to owe more. So that's what this person's considering in the membership. Is she's like, well, I'm kind of stuck trying to figure out how this is going to work. If I pay these estimated vouchers, I either find myself way underpaying or way overpaying. How do I handle this? The better way to do this, as opposed to using the vouchers as the end all be all, the better way to do this is look at your profit every quarter, your actual business profit. And that involves, I'm going to say it, bookkeeping. And you have to be aware of how much are you making every quarter. And then I would say, depending on what state you're in, okay, because your states could charge anywhere from like a 5% to even like a 10%, hey, California, sales tax, or not sales tax, excuse me, income tax on your profits. So you have to really be mindful of, okay, I'm probably going to owe between 25 and 30% of this amount of money, of the profits. So it's probably safe to sock away, as you put it, 30% of your profit at the end of each quarter, put it in a high yield savings account, or do it as you go if you prefer. Then every month, maybe take that amount of your profit, put it away into a savings account and lock it up. But here's where my advice deviates from a lot of accountants. What I do typically with my clients, and you have to know this case by case, but what I typically advise my clients to do, because of the volatility in most of my clients' businesses, what we end up doing is we skip Q1 estimates because they're due April 15th. And we're already past that, I believe, oh no, we're not past that yet in this air date. So you still have time. But the Q1 estimates are due April 15th. And that usually coincides with paying taxes from last year and catching up on certain other things that it can fall as a lower priority. So what I mostly encourage people to do is, if you're not going to pay your Q1 estimates April 15th, which is okay, it's not the end of the world. I'll tell you what happens if you don't pay in a little bit. But what I would encourage you to do is still put that money aside. And then when Q2 estimates come around June 15th due date, then you might want to overpay those. You might want to catch yourself up. But what I sometimes tell my clients to do is skip payments 1 and 2. I know accountants are going, oh, what? Skip payments 1 and 2? Yes, here's why. Because we have so little control over the overall picture of how we're going to spend the year, because there can be seasonality. There can be fluctuations in business income, that to make those first 2 payments and to commit to, this is my profit for the quarter and I'm going to pay it, and this is my profit for quarter 2 and I'm going to pay it. What if Q3 and Q4 are losses and now you still overpaid and your overall loss for the year, you're going to get all that money back? So here's possibly, I should say, little asterisk, but here's what I'm trying to articulate is that you don't want to, count your chickens. You don't want to get too far ahead of yourself. The better behavior, in my opinion, and this is just my opinion, is to set aside that money in a high yield savings account, liquid, so that you can call on it when you need to make that payment if you so choose. But know that it's set aside for that exact purpose. It's there for you when you need it. But if an emergency should happen, or that number should fluctuate, or the amount you're going to owe overall increases or decreases drastically during the year, you're keeping track of that and you have that money set aside. That is the most important thing, is that you're ready to pay it. What happens if you don't actually make the payments, but you keep all that money to yourself? Well, you get hit with this small underpayment penalty. And I'll say most of the entrepreneurs I deal with, when they see the underpayment penalty, it's relatively insignificant. We're talking about a couple $100s on average, for most business owners I work with. It's like a few $100s, maybe $1,000, maybe $2,000, $3,000. And it's a small price to pay for some to have access to that money during the year to reinvest into their business if they needed to, or to call on it if they really needed to in an emergency. Especially with so much uncertainty happening. It's an election year. So many things are happening right now that in your business as well, like, it's really hard to predict. If you don't have a really steady stream of cash flow that's guaranteed, then I always say there's always a little bit of risk in giving your power away to the IRS and handing over that money for them to keep. You don't get it back until the next year. So before you lock it in the safe, just hold on for a second and figure out, do I want to put this away? So that's kind of my take on the tax estimates. But the way I would estimate this is roughly 30% of your quarterly profit is what you should be keeping to the side, whether you're paying it to the IRS or not. Follow your tax pro's advice, but you should be considering putting that aside and having that ready to go, because then you'll be well prepared come tax season the next year. These are not arbitrary numbers, guys. When you get your tax return back, it's not arbitrary what you owe. You can actually have control over this. You can actually predict it. One thing we do for our clients every single year, and I encourage you, ask your tax professional to do this for you, and pay for it if you have to. It's worth it. Do a pro forma in July. What we do is every July, we go through all of our clients' financial information year to date. And again, this requires good bookkeeping. This is another big value in bookkeeping, is you can do this. So we take the January through June financials and we run it through what's called a pro forma, AKA a dress rehearsal. We do a fake tax return as though the first 6 months of the year are going to replicate themselves in the second half. And we plug in certain estimates based on what we know about the client. We then present it to them and say, hey, if you keep doing what you're doing, it's looking like your liability is going to be about X. So let's say if I told you that your liability for April is going to be about $8,000, that might really suck if I called you on April 14th and I was like, hey, by the way, you owe $8,000 tomorrow. Like, nobody wants to get that phone call. Nobody wants that like hesitation of the anticipation of waiting. But if I told you that in July, if I said, hey, you might owe about $8,000 and you have T minus 9-10 months to save that up. Could you save $800 a month between now and April if it's July? Damn well, you probably could. And then all that money is right there and it's already earmarked. You'd be amazed at how much you think your problem is a big tax bill when really the problem is the short notice or the surprise about the tax bill that can be easily predicted within, say, a ring of the bullseye. Don't hold your tax pro to, predicting the future. But if you throw in certain assumptions of what you think would happen and you have a general idea of a range in which it could fall, that is insanely powerful for you as an entrepreneur to be able to plan. Because now you can set aside cash every month to go toward that particular purpose if you've saved up nothing this year so far. So just understand that this is something you can definitely estimate, you can definitely take control of, and you're 100% in the position of power to decide if you want to work with someone who does exercises like this with you and actually gives you that advance notice. It is possible. There are just a lot of people, a lot of, CPAs, a lot of accountants that have shops where their entire thing is churning out tax returns year round or even during the season. And then they take the rest of the season off because they're so exhausted because they work 50 hours a week. That is the traditional way firms are run. And frankly, us as business owners, we just operate differently. I don't think the model of typical CPAs really fits the modern minded business owner right now because we want to be able to anticipate, we want to plan, we want to, know what's coming down the pike, not just what we already hit. So that's where fractional CFO services come in. That's where finding someone who's a little bit more forward thinking comes in. But if you have a tax pro right now, you're working with them right now and you're like, look, they're doing a good enough job. I get my taxes done. I just need a little bit more guidance throughout the year. I got to feel more connected. I got to feel like I'm really getting involved in my finances. Then look no further than CFO On Demand, which is where this question came from. CFO On Demand is a monthly service where I and other CFOs can jump in and help you. And we're there to support you. We basically answer questions every day, questions just like this, with voice notes, videos, and texts to make sure you're in full power over your money and you understand in ways that you can actually grasp and digest how your money works as an entrepreneur. And that has been the mission since day one, is to supplement the services of typical CPAs who maybe are just really focused on the paperwork, where we can be focused on the perspective and giving you what you need to succeed. So if you're interested, check out the link in the show notes to learn more about CFO On Demand. We would love to see you in there. Most accountants will try to bill you for those quick questions or make you feel like you're bothering them. And the truth is that the quick questions are what I love about what we do. That's why I created a new and accessible offer for you to be able to message me your questions and get the support you need when you need it. It's called the CFO On Demand. You can now get affordable help and access to me and my team without a high monthly fee. You can also upgrade and get access to a private one-on-one office hours to bring your specific strategies to the table. Want to learn more? Head to thecfoondemand.com or click the link in the show notes. Again, that's the CFO On Demand. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.